Would you buy the Bitcoin dip if your principal was fully protected? Hello everyone, I hope you're healthy and well, and welcome back to Markets with Marcus. So, Bitcoin. Many own it, even more people talk about it, but who really understands it? At the time of this taping, and after some recent volatility, Bitcoin is trading 20% below its last all-time high from a month ago. If Bitcoin's track record tells us something, it's that it has always been volatile, with steep and sometimes violent ups and downs. And the question that comes to mind for many aspiring crypto investors is whether an investor should use the opportunity and buy this Bitcoin dip. Now, crypto is not for everyone, and it can be complex. So, before you jump in, let's discuss a few important questions. Here are the 3 topics that we will be covering today. 1. How does Bitcoin work? And what are the arguments for and against investing in Bitcoin? 2. How can you get exposure to Bitcoin? There are many different ways to do this, and some of them even promise to guarantee your principal, which may be particularly attractive for investors who want to get started in Bitcoin, but don't think that they can stomach the volatility. But more on this later on, because, as Jen likes to say, in life and in money, there's rarely a free lunch. And 3, what's our personal opinion? Let's get started. How does Bitcoin work, and what are the arguments for and against investing in Bitcoin? Estimates of how many cryptocurrencies are out there vary widely, from hundreds to many thousands. But there's agreement that there's only one Bitcoin. Bitcoin's market cap, the aggregate value of all outstanding coins, is about $2 trillion currently, which is more than all the other cryptocurrencies combined. That's why we will be focusing on Bitcoin in today's video. Do keep in mind that every cryptocurrency follows its own rules. These are all private creations that are only subject to the laws of supply and demand, but do not have many other regulations or constraints. Every crypto founder can set their own conditions about how their coins can be created, traded, and potentially even destroyed. So, what we'll be discussing for Bitcoin today may not necessarily apply to other cryptocurrencies. That said, the one thing that all cryptocurrencies have in common is that they rely on a relatively new technology known as blockchain. Blockchain is often defined as a decentralized, distributed ledger technology that securely records transactions across a network of computers. Of course, this description often leads to more confusion than clarity. I personally like to compare a blockchain to a land register. A land register is a public list of all pieces of land in a county, their current owners, and all the transactions around the land, from sales and purchases to divisions of lots. It's where you go if you want to buy a house and want to verify that the person who proposes to sell it to you is really the current owner, and also to make sure that once the transaction is complete, you are registered as the new owner. A blockchain follows the same basic idea. So, sticking with our Bitcoin example, a blockchain is a public list of all the Bitcoin that have ever been created, their current owners, plus a record of all transactions ever conducted with all these coins. And if you want to buy Bitcoin on the market, you would turn to the blockchain to make sure that the seller actually owns the Bitcoin that they propose to transfer to you, and to get yourself registered as the new owner. So far, so similar. But there are 2 crucial differences between a land register and a blockchain. First, decentralization. While the land register is maintained centrally by a government office, a blockchain has no owner. It is distributed in the sense that it lives electronically on thousands of computers at the same time. All these separate computers are called nodes and follow the same rules. There is not one single office or person you can ask to approve the transfer of a coin from person A to person B. Instead, you have to propose this transaction to all the computers, all the nodes in the network for a vote, so to speak. If a majority of the nodes in the network agree to a proposed transaction, the coin changes hands and you are shown as the new owner in the public register. And the second difference between the land register and a blockchain is anonymity. This can be a bit confusing. How can it be anonymous when every Bitcoin transaction is displayed publicly on the blockchain? But the answer is simple. You don't have to give your real name to trade Bitcoin. You can use a pseudonym on the blockchain, an alphanumeric address basically, and as long as you do it all yourself and don't use a broker, there is no identification required for any step of the process. You can amass a Bitcoin fortune via this pseudonym, this alphanumeric address, and it would not be immediately obvious to the outside world that this pseudonym is tied to you. That said, and to go back to our comparison to the land register, even if you use anonymous trusts and shell companies to disguise your ownership of a piece of land, it may still be possible to track you down as the ultimate owner with a bit of detective work. Similarly, crypto experts and law enforcement may use any traces you leave behind to identify you, for example, IP addresses. Plus, they can always track what you do with a Bitcoin that they have identified. Remember, all transactions are public. So, the anonymity of Bitcoin ownership that is so often talked about is relative and can be short-lived in some cases. Now, this is a very simplified overview, and the technical details can be confusingly complex. For example, the name blockchain itself comes from the fact that all these transactions are not processed one by one, but grouped together into a block of maybe a few thousand transactions that are all verified and recorded together as one batch. And because all these batches or blocks are building on each other, they form a chain of blocks, or a blockchain, hence the name. And exactly because the underlying setup is complex, many, if not most, investors will not hold their cryptocurrency themselves, but use a broker such as Fidelity or Coinbase to access the world of crypto. This broker will take care of the technical side for you. As for the underlying technology, you only need to know that Bitcoin is generally seen as a safe and secure cryptocurrency. While there is fraud and theft, it happens less at the blockchain level. There are too many checks and controls in place, but more at the owner level. Your Bitcoin lives in the blockchain, but you control them with your private key, which is like the password to access your Bitcoin. And much criminal energy is spent on trying to get people to hand out their private keys or to send their Bitcoin to a recipient who shouldn't be getting it. Bitcoin transactions are irreversible. Once you enter your private key and send a coin, and the transaction is validated and registered in the blockchain, that's it. The coin is gone, and you'll only get it back if the new owner sends it back to you, which is very unlikely if it's a fraudster. Now that we know how Bitcoin works in principle, let's have a look at why it has become popular with investors over the past few years. Here are the top 5 reasons for investing in Bitcoin. Reason 1. Bitcoin has a strong long-term historical track record. Keeping in mind that past performance is not indicative of future results, this track record and the corresponding hope for continuing high returns in the future are probably the main reason why many investors are starting to get interested in Bitcoin. If we look at the performance of Bitcoin from 2014 to the end of 2024, Bitcoin showed an almost incredible cumulative return of 12,447%, meaning its price went up more than 120 times over those 11 years. And before you ask, the weakness of the past few days hasn't really changed the fundamental picture. At the time of this taping, Bitcoin is still trading 9% higher than at the end of 2024, which was the cutoff date for this table. NestEgg, with its strong tech focus, comes next, with a still impressive but distant 554% cumulative return, followed by the S&P 500, shown as SPY here, with 289%. Many other popular investment classes were even further behind. ACWI, the MSCI All-Country World Index, a global equity index that tracks large and mid-cap stocks in both developed and emerging markets, only returned 152%. Gold, high-yield bonds, emerging markets and HEG, iShares Core US Aggregate Bond Index, had all decent returns, but didn't even double over the period. Now, as so often, the high overall performance comes at a price. High risk, high return, as always with investments. And we will return to this chart later. Reason number 2 for investing in Bitcoin. Bitcoin is a decentralized peer-to-peer network, as the die-hard Bitcoin fans like to call it, which is a fancy way of saying there's no direct government control, at least historically. Traditional currencies are always dependent on their central bank and, if cashless, on commercial financial institutions. Bitcoin, on the other hand, as a decentralized peer-to-peer network, is seen as something that is not directly controlled by any government, central bank, or other institution. In that respect, it's more like gold, precious metals, and other commodities than any national currency. That said, in real life, most owners of Bitcoin will still hold them indirectly via a bank or other financial institution, which are, of course, subject to government and regulatory oversight. More about that later. Reason number 3 for investing in Bitcoin. Bitcoin offers inflation protection. Bitcoin is a finite commodity. The way its underlying software has been programmed, only 21 million digital Bitcoin will ever be created, or mined, as the crypto industry says. At the time of this taping, almost 20 million are already in circulation, so there can only ever be 1 more million coming to the market. Bitcoin supporters point to this hard-coded scarcity when they propose Bitcoin as a stable hedge against inflation, especially in comparison to the dollar or, frankly, all other national currencies that can, at least in principle, be created at will and in unlimited amounts by their central banks. Reason number 4 for investing in Bitcoin. Bitcoin offers portfolio diversification. Even if you're not strongly invested in Bitcoin, a small allocation within a portfolio may diversify your risk. In this context, most financial professionals would consider Bitcoin as part of the alternative assets category. Reason number 5 for investing in Bitcoin. There is increasing regulatory clarity and support. The Biden administration approved Bitcoin ETFs in 2024, and the current administration continues to open up the financial system to cryptocurrencies and put a regulatory framework in place. This should create new use cases, maybe even for day-to-day payments, and help its mainstream adoption. Now, reason number 2 for investing in Bitcoin, no direct government control, and reason number 5, increasing regulatory clarity and support, are particularly interesting. While no government control historically was what early Bitcoin investors pitched as a selling point, Bitcoin really shot up again in value when the Biden and then later the Trump administrations gave Bitcoin their stamps of approval. So maybe a bit of government oversight and validation is not so bad after all for Bitcoin. So now that we've covered these top 5 reasons for investing in Bitcoin, let's take a look at the top 5 reasons that speak against investing in Bitcoin. First, Bitcoin is volatile. The same chart that showed you the overall strong performance of Bitcoin over the past 11 years also shows you the sometimes extreme ups and downs along the way. Over the past 11 years, Bitcoin was either the best or the worst performer in any given year. In 2014, 2018, and 2022, Bitcoin lost 58, 74, and 64% of its value, respectively. Now, it recovered later on, but this roller coaster ride is not for the faint-hearted. And the past month, up to this taping in early November, has again confirmed that Bitcoin continues to be quite volatile. It's not just that Bitcoin is down 20%. Other cryptocurrencies, such as Ethereum, XRP, the former Ripple, Binance, and Solana, have performed even worse, with losses as high as 34% for Solana, as you can see here. And please ignore Tether on the list. This is a stablecoin whose value is, by design, always $1, or at least very close. The second reason that speaks against investing in Bitcoin is that there is a lack of intrinsic value and practical applications for Bitcoin. Bitcoin is currently used more for speculation than for actual business transactions. Also, unlike official national currencies, no one has to accept Bitcoin as payment. Now, there are a handful of sellers, like Shopify, which have started testing payment via cryptocurrency. But these offerings are entirely voluntary and they are the exception rather than the norm. The third reason that speaks against investing in Bitcoin: the regulatory environment is by no means certain. Yes, there has been a lot of progress, but as I mentioned before, it's still not at the same level as for the more established parts of the financial system. And who knows how future administrations might approach the topic. The fourth reason: security and fraud risks remain. As I touched upon earlier, Bitcoin is, in principle, a safe and secure cryptocurrency at the technical level. But there is fraud, scams, and some criminal activity around the fringes. And many of us will remember from the sudden collapse of FTX that some parts of the emerging crypto ecosystem may not be as mature yet as the traditional, heavily regulated financial system. And the fifth reason against investing in Bitcoin: it is not great for the environment. Now, this may not be a decisive factor for everyone, but some are concerned that Bitcoin mining uses large amounts of electricity. And there you have it, the top 5 reasons for and against investing in Bitcoin. Please keep in mind, once more, that past performance is not indicative of future results, events, or outcomes. But let's say that you come to the conclusion that you may indeed want to buy the dip and start dabbling in Bitcoin. Or perhaps you're just curious about it all. Then the next question is, how can you actually invest in it? How can you get exposure to Bitcoin? There are really 3 ways for getting some exposure to Bitcoin. 1. You can buy Bitcoin directly via an established broker or some of the younger crypto exchanges that have sprung up in recent years, including Coinbase, Robinhood, and Kraken. These are usually online-oriented and offer not just Bitcoin, but a wide variety of crypto-related products and services. Coinbase, for example, supports more than 250 digital assets, from major coins like Ethereum and XRP to numerous smaller ones. And for what it's worth, Bitcoin can be transferred in fractions as small as the 8th digit behind the comma, 0.00000001, which is equivalent to about 0.1 cent at the time of this taping. This smallest unit of Bitcoin is called a Satoshi, after Bitcoin's legendary founder, and 100 million Satoshi make up 1 Bitcoin. If you want to stick with a more established brokerage, Fidelity is the one leading firm that offers Bitcoin right now via their Fidelity crypto account. Fidelity's cryptocurrency offering is generally more restricted than for the more specialized newer firms in terms of products and services offered. You also must be a US citizen over the age of 18 and reside in a state where Fidelity digital assets can serve customers. As far as we could gather, Schwab and E-Trade do not currently offer direct Bitcoin investing, but are planning to do so in the future. However, it's probably fair to say that Vanguard is more conservative in this space, or perhaps even outright skeptical. According to the official statement on their website at the time of this taping, Vanguard's take is that since cryptocurrencies are highly speculative in their current state, Vanguard believes their long-term investment case is weak. They do keep the back door open though towards the end of the paragraph, stating that as cryptocurrencies become increasingly mainstream, we'll continue to monitor their development and discern the best path forward for our investors. Now, when you buy Bitcoin directly in this manner, please know that it's not SIPC protected. Meaning, for example, that if you have an account with Coinbase, or even if you have a Fidelity crypto account, and either one of those firms go bankrupt, and your crypto holdings are missing and nowhere to be found, the SIPC will not come in and make you whole up to their standard protection limits, because direct holdings in crypto are not SIPC protected. Which is a nice segue into the second way for a retail investor to get exposure to Bitcoin. You can invest in an ETF that holds Bitcoin. Bitcoin ETFs, as the name suggests, hold a portfolio of Bitcoin, are registered with the SEC and listed on a US exchange. So they are generally easy to access and trade. Even better, Bitcoin ETFs, like all other ETFs, are SIPC protected if held in an account with an SIPC member firm. That said, like any ETF, they usually charge a fee and they do not give you direct ownership of the underlying assets. There are some Bitcoin ETFs on offer, but BlackRock, Fidelity, and Grayscale really seem to dominate the market with a sizable gap to the next followers. By far the largest is BlackRock's iShares Bitcoin Trust ETF, or IBIT. It started trading on January 11, 2024, the first day this was allowed for spot or cash Bitcoin ETFs, has total assets of 83.2 billion and charges 0.25% expenses at the time of this taping. Fidelity's Wise Origin Bitcoin Fund, or FBTC, is next on our list. It started trading on the same day as IBIT and charges the same 0.25% of expenses. But it is smaller, at 20.9 billion. The third Bitcoin ETF on our list is from a newer firm that specializes in managing cryptocurrency and other digital assets. The Grayscale Bitcoin Trust ETF, or GBTC, was basically converted to an ETF in January 2024 from a trust structure that had been established in 2013. According to Morningstar, GBTC has 17.8 billion in total assets, not that far behind FBTC. But it does not come cheap, with an expense ratio of 1.5%. And maybe this high expense ratio is the reason why Grayscale launched the Bitcoin Mini Trust ETF, or BTC, in July 2024. BTC is essentially a spin-off from GBTC, but it is significantly smaller, with only 5 billion in total assets. And it only charges a tenth of the expense ratio of GTPC at a mere 0.15%, even cheaper than IBIT and FBTC. All of these ETFs are passively managed and pay no dividends. Their year-to-date and one-year trailing returns, the longest available track record on Morningstar at the time of this taping, given their relatively recent launches, have been tracking the Bitcoin price reasonably closely. That said, there are two observations here. GBTC's returns are generally a bit lower than for the other ETFs on the list, because of its high expense ratio. And while BTC's one-year trailing return is in line with IBIT and FBTC, its year-to-date return is a bit lower on a price basis, which may indicate lower liquidity or another anomaly, at least temporarily. Moving on now to the third way to get Bitcoin exposure. You can also invest in instruments that add one or even two additional layers of financial engineering on top of the underlying Bitcoin risk. Now, financial engineering can be used for many different purposes. We'll show you here 3 examples that are structured for different purposes, and we'll show them in the order of when they became available on the market from oldest to youngest. On top of this chart here, we find Strategy Inc., ticker MSTR. Since 2020, it defines itself as a Bitcoin treasury company, which means that their business model relies on holding Bitcoin and applying some leverage to it, essentially borrowing money to buy even more Bitcoin. Although they are still officially a corporation and not a fund, their operating businesses do not meaningfully contribute to their bottom line anymore. Now, leverage amplifies upswings as well as downswings, and we see that their year-to-date return of minus 11.95%, as well as their trailing one-year return of 11.94%, lag behind the Bitcoin ETFs, which comes from the leverage, which has amplified the impact of the downturn that we've seen over the past few weeks, as expected. Bitcoin itself and most Bitcoin-based investment products pay no dividends. That's a gap in the market that the YieldMax MSTR Option Income Strategy ETF has been trying to fill since early 2024. They write options on MSTR Strategy Inc. and pay out the options premiums as dividends to their shareholders. MSTY's trailing 12 months distribution yield is an almost unbelievable 219.69% as per Morningstar. But the trade-off is that the high payouts may cut into the substance, so to speak. MSTY's total return is minus 11.69% year to date and only 5.87% for the last year, the lowest on the list so far. We've linked our video on MSTR and MSTY below if you want to have a closer look. While both MSTR and MSTY accept additional risk to get more return or cash income out of the underlying Bitcoin exposure, there are also structured products that do the opposite. They limit the downside risk of Bitcoin. But it comes at the price of having the upside kept as well. We took one example here, the Calamos Bitcoin Structured Alternative Protection ETF, from this last October, ticker CBOO. It can give you capital protection, meaning there is no real downside to your investment. But at the same time, the upside is kept. That's the price you pay for the downside protection, as I said before. In addition, there are 2 important restrictions. The full capital guarantee only works after expenses, and if you buy CBOO exactly at launch and sell it exactly 1 year later. at the end of what Calamos calls the outcome period. Let me explain what I mean. So, if you bought CBOO at launch on October 7th, 2025 for exactly $25, you know in advance that you will get back at least $24.83 per share 1 year later on, October 6th. That's your principal minus the 69 basis points in annual expenses. And the same principle is true for the upside cap. If you bought CBOO on October 7th, 2025 for exactly $25, you know that 1 year later, on October 6th, 2026, the price per share cannot be more than $26.95. In other words, your upside is capped at 7.78% after expenses on your initial investment. However, if you buy or sell CBOO at any point in between these two dates, the share price will fluctuate and you will pay or receive whatever the market offers. And that may be more or less than on the launch date. And exactly this mechanism allows you to buy the current Bitcoin dip basically risk-free. At the time of this taping, at market close on Thursday, CBOO's market price stood at $24.74 on Calamos platform. Now, as I said before, the guarantee and cap for CBOO remain exactly where they were set at launch. So, if you were to buy CBOO right now for $24.74, you know for sure that after expenses, you will get a price of at least $24.83 per share if you sell it again on October 6th, 2026. Meaning that in this case, not only do you have your full initial investment guaranteed, but you've even locked in a small minimum gain already now if you hold your shares for that long. On the other hand, you also know that the maximum share price on October 6th, 2026 will not be more than $26.95, limiting your upside to 8.84% of your investment after expenses and with some rounding. So that's what we mean when we say that you can buy the current Bitcoin dip with full principal protection and some upside limitation if CBOO works as promised. But of course, structured protection ETFs can be complex and everyone's financial journey is different. Drop me a note below if you would be interested in diving deeper into the topic in a separate video. How it works, what other similar products are out there, and what we make of it. Now let's move on to the next section for today's video. What do we in the Llama family think of Bitcoin? What's our personal opinion? Personally, we are a bit torn. On the one hand, and the recent volatility notwithstanding, Bitcoin has built an impressive historical track record and has been steadily moving closer to mainstream investing. But Bitcoin's volatility, lack of intrinsic value, ongoing uncertain regulatory environment, and security and fraud risks are significant enough reasons for us to not consider it as a mainstay investment for our portfolio quite yet. However, we could imagine getting some Bitcoin as part of our alternative investment allocation strategy. Although it would never be more than we could afford to lose, which is generally our rule with more speculative investments anyway. And if we were to decide so, we would be tempted to buy the current dip. As I mentioned before, Bitcoin is still 20% below its last all-time high from just a month ago at the time of this taping. And if Bitcoin's track record tells us something, it's that it has always been volatile, with steep and sometimes violent ups and downs. Now, past performance is no indicator of future returns or outcomes, and who knows, but we could at least hope for some gains again. As we always say, everyone's financial journey is different. and you need to have a strong conviction about its future success and or find these top 5 reasons for investing in Bitcoin compelling enough to at least dabble in it a bit. And if this is you, here are our 3 golden rules for Bitcoin investing to keep in mind. 1. Educate yourself first. Bitcoin is new and unfamiliar to many investors. It's not like adding a new equity, bond or fund where you probably know the risks and how it works in principle. Invest enough time to understand at least the fundamentals of Bitcoin and its specific risks. Today's video is only meant to be a first overview. 2. Make sure you can handle the volatility. As we discussed before, I personally would not pencil in any future returns, but rather be prepared to lose some or, in the worst case, all of my initial investment. Remember this chart from before. Over the past 11 years, Bitcoin has been doing either really well or really badly. If you are someone who loses their sleep when prices drop, you may want to think twice before jumping into crypto land. 3. Start as simple as possible. If you decide to invest in Bitcoin, it may make sense to begin with a spot or cash Bitcoin ETF from a trusted asset manager, such as IBIT or FBTC. Personally, I think that these are easier to understand, access and trade for a Bitcoin beginner. Plus, they are protected up to the standard levels in the event that your SIPC insured broker were to go bankrupt and your securities were to go missing. And only if you have the stomach and the knowledge for it. Then you may want to consider exploring a direct investment in Bitcoin, which again is not SIPC protected. And if you're tempted to buy the current dip without downside risk with a structured protection ETF like CBOO, always make sure you fully understand how it works before you invest. And on that note, I will leave you with the message that Fidelity displays prominently and repeatedly on its crypto pages. Crypto is for investors with a high risk tolerance. Investors could lose their entire investment. Do drop a comment below. Is Bitcoin something for you? And if so, what is the decisive factor for you? And if you already own some or are planning on picking some up, how much will you be buying and what will you be buying? Bitcoin directly, an ETF like IBIT or FBTC, or a leveraged product like MSTR and MSTY, or perhaps an ETF with some degree of guaranteed principal return like CBOO, or are you taking a wait-and-see approach for the time being? Alright everyone, I hope you enjoyed today's video and learned something new about Bitcoin. And I hope to see you soon again on Markets with Markus.